Hi, I'm Stephen King, CEO of GrowthForce, and welcome to Put Your Numbers to Work podcast. I'm excited to be joined by a longtime client and partner of GrowthForce, Chris Williams, President of Quality Lease Services. Chris, welcome to the show.
Thank you very much, Stephen.
I appreciate you making the time to be here. You're one of my favorite clients, and why I wanted to invite you to our podcast, because you really use the numbers every day. It's almost like a hobby, right? It's a passion. And so this podcast is about getting the people that I know who are the best at financial management and financial management strategies and sharing them with people who want to be really good at it. So let's first talk about, what is Quality Lease Service? What do you do? What's the business model?
The business model is that we supply housing and what I call ancillary services to rig sites.
What's a rig site for people?
A rig site is for people outside of Texas.
Yeah.
A rig site is where they drill for oil. Mm-hmm. So typically a rig site will have a huge drilling rig. You sometimes see them as you go down the highway, and then surrounding or within a probably 100-yard proximity, there'll be anywhere from 6 to 8 or 9 houses, and in these houses there are different functions. One could be a safety house, one could be a crew house where people sleep, and one could be a control house. So we supply those houses, and every time that rig moves, we move with them, and we move our houses. So we have a trucking fleet that moves the houses, and we also take care of water and sewer, what you call gray water. So we will bring fresh water in, non-potable, but it's used for showering,
mm-hmm.
washing, and all the rest of that. And then we supply a system that collects the effluent, and we'll take that to a disposal site.
So you make a little city around the rig site. So
yes. I don't know how many people are on a rig site at any given time, but probably 100 and some odd.
Oh wow!
Yeah,
that's pretty big. So we met. You were brought in by some outside equity partners.
Yes.
Looking to help with the turnaround.
Yes.
And so, talk about your background and what your role is and how that's worked.
I was called in to look at a situation on behalf of an equity firm that was a deal that had gone south almost immediately after acquisition. Basically due to activity on part of the sellers that, in my opinion, was totally inappropriate, unethical, and a long list of things. Okay. But be that as it may, they had a problem, and they wanted to say, is this a viable business or is it not? Would you take a look at it? The people that bought the business were in Florida, in Tampa. And so I flew out to Tampa basically to get the lay of the land. And when they acquired the business, the organization in Tampa had their own management team. So that management team based in Tampa was running this business that at the time was based in South Texas. Within about 3 months, the acquiring partners decided that they would like to be able to step back from it, and we kind of knew what direction this was going to go, which was eventually into bankruptcy. So I was asked to come in and run the business, and actually for a short while I actually owned the business. And so when I brought in GrowthForce, we had a team of probably 6 people doing accounting, or maybe even 7 at a very high cost.
Sure.
And I wanted to subcontract that, bring it back to Texas. I did not want to have the difficulty of hiring a controller and a financial team that I would have to supervise, worry about, what if somebody left, because it's a small company, it's not exactly a career path.
Yeah.
So that's where GrowthForce was engaged.
And if I remember correctly, I think we saved you about 40% on the cost.
It was huge.
Yeah.
Yes.
So that helped the bottom line.
It helped a lot, yes.
And all through automation. So how do you think about numbers, right? Where do you start in your view of a financial statement, and then let's work backwards from there, and how do you get to decision making, from those financials?
Okay, I start at the end. Mm-hmm. So I start, that my objective is to make money.
Right.
So there are so many factors that go into making money that you have to kind of trace them back.
So you're starting at net income.
I start there, and when I go in, because I did turnarounds for many years, and the first thing I would do on a turnaround situation, I would look at their income statement, and I would take it and I would assign, regardless of how it was assigned in the income statement, I would say this is variable or semi-variable or fixed. And then I would create my own income statement as a derivative of the actual income statement. So the numbers always match at the bottom line, but the makeup would be different. The key is that the variable expenses should track and flow with the revenue side. And that is the key to kind of controlling it. Now, on the overhead side, obviously you can look at that and you say, what can I eliminate from overhead? And there's usually something you can do, and GrowthForce is a good example. That's accounting is an overhead expense, right? So if you can reduce overhead from 100,000 a month to 75, that stays with you.
Right.
Now on the flip side,
we weren't even close to that though. But anyway, if it's 15,000 to 10,000, that's a third, right?
Right.
Yeah.
So it's a big number. So you control that part, and then there's a lot of pieces inside of that, like insurance, property taxes, other things that that's a separate track, but those are usually one-off decisions.
Right.
Now, the actual running of the business consists of the revenue side and the variable expenses.
So when you say variable expenses, you talk about all the above the line costs in cost of goods sold?
Basically, yes.
Okay.
I'm saying, the theory is if you're getting $1 in revenue and it costs you 50 cents, okay, then as you track up and down, that ratio should stay the same, 50% ratio.
So you're looking at gross profit as a percentage.
Yes.
And then measuring all those above the line costs to make sure you're hitting your number.
Right. And seeing which ones contribute to what. So that's the dry side of it in a sense. And when you're dealing with financial statements and income statements, you're typically getting that information 3-4 weeks after the end of the month, which it's nice to have, but in terms of affecting the business, it's not very useful.
It's after the fact.
Right, it's after the fact. It's done. You can't do anything about it. So it's possible that you made a mistake in week 1 of the month that you just closed, and you're now in week 7.
Right.
And wish you changed it in week 1, right? So week 2 didn't duplicate it. So my concept is you go all the way back to what generates the numbers, and then you start putting those together in a format that the people that make those on the ground decisions, from truck drivers to their managers, to anybody involved, so they kind of understand what their role is, and give them visibility on something that they can do something about.
In real time, or near real time.
Yeah.
Is that like on a weekly basis?
Oh yes, absolutely. Yeah. Everything goes out weekly. They feed information. The thing that's changed, I've been doing this for so many years, but the thing that's changed is so much information is now accumulated electronically.
Yes.
So you never have to duplicate anything. It's just a matter of finding the source, putting it together, and then interpolating it in a fashion that somebody comes up and says, "Oh, I see what happened." For example, you have to do payroll. We pay weekly.
Right.
We know who has to get paid what. We have to submit that information to payroll, so we know who the people are, how many hours they worked, and during a specific week. So that has to be put together. So that information is furnished to me electronically. Well, I know who's a truck driver. I know who's a service tech. I know who's admin, and so forth. And I know by putting it together in a spreadsheet how much overtime was worked, because you just make a calculation.
Right.
So at the end of a week, so right after the week is over, within 2 days, the manager will be able to see, hey, here's how much overtime you ran, here's how much revenue, here's how much revenue per hour, all of the things that make up, at the end of the day, a profit for the company. And you can then take action on it. So that's really important.
That's fantastic. I'm passionate about intersecting of financial management strategies with human capital management strategies. Right. And I know you've got an HR background.
I do.
And one of the things that I really admire about what you've done in your career and in this business is you drill those targets, those gross profit targets from the company to the department down to the manager,
Right.
and then you reward them with a bonus based on gross profit.
If they have the gross profit, yeah.
So-
I want, I've preached this, to the company for a long time. I want them to feel like they own the business.
Yeah.
I don't want them to feel like they're just employed there.
Right.
Now, you're not going to get through to everybody on that concept, but you will get through to some. And one of the things that I remember a long time ago, I went to hear a talk by Gordon Bethune about Continental Airlines, and Continental Airlines was talking about their performance targets, on-time arrivals, baggage handling, a couple other things, and they would give like $25, as a bonus, quote unquote, to all their employees when they hit certain targets. And I'm thinking, here's a huge company that pays these people very well, and that became a big deal for these people.
Right.
So I do the same thing. We have a profit, 2 months in a row, or I should say we're doing well. I'll give everybody a gift certificate, and that's their way of knowing, hey, we did okay. And if they don't get one, that's our way of questioning, like, oh, what did I do wrong?
What management monitors gets done, right?
Yeah.
What you're doing is you're just letting everybody know, I'm paying attention and your performance has helped us.
Absolutely.
And it's the recognition, even more so than the reward, is what the studies show, that, all right, my boss knows I'm doing a good job. And by the way, I got a $50 gift certificate.
Yeah. And I want them to think they're part of it. To me, since I come out of an HR background, I think one of my most revealing things was I was on a big plant in Connecticut, and I was responsible for HR. And I went out, and they had kind of a piecework system, and I was talking to some of these people that worked on the line, and then I would ask them, what they did, outside the factory. And people say, well, I'm an alderman, which is like city council or something. And I'm thinking, these guys aren't just people putting things together. They're people with another life, and they're by and large very capable, smart, and can contribute.
Yeah.
So that's always stuck with me. That was 30, 40 years ago or whatever.
So let's talk about the visuals, right? You got non-financial managers on your team, and do you show them charts and trends and graphs?
I do. A visual has an impact. You can see something. So I gather all this information in Excel, and I've got one worksheet with several tabs, and one of the tabs is a chart. So the charts are generated in Excel. They're pretty automatically done because I created it that way. And I'll copy paste them into an email, and I'll give him anywhere from 3 to 5 or 6 charts. He gets all of them in the Excel file also, but under each chart I can say, this is what's happening, this is what's happening, look at this. So he's able to see actual months compiled and then actual weeks for the current month. So he can look back and say, yeah, I'm doing much better than I was, period to date or whatever, in May of last year. I'm doing much better this May. But he may have said something to me, say, I had to run, for example, the truck drivers work more overtime, and we had more truck drivers because I'm increasing the staff. So I had to deadhead a lot of them for training purposes. And I said, I understand your labor cost is going to go up for that week. On the flip side, in the following week, and I should see it, is we should have the reverse effect.
Right.
These drivers are now in their own trucks generating more revenue. Our average cost is going down.
Right.
So he knows that I can see it.
Right.
He can see it, and we'll see if we accomplished our results.
And as a non-financial manager, a picture really makes a difference.
Absolutely, just bar charts.
That's a lot. And I've never heard of anybody, though, putting them into an email and then a couple of bullet points underneath helping them understand what it says. That's brilliant.
Yeah.
So how does that translate into, decision making and with your managers, and what reports are you giving them?
Okay.
And then what kinds of decisions do they make from those reports?
Okay, let's take, when we did the intro, we were talking about the business. There's 2 parts of our business, actually. It's the housing side, and then we also do trucking. So we haul salt water from drilling sites where it's already completed, and oil and salt water separate, and then we have to haul the salt water to a disposal site. So in that instance, we have X number of drivers. Let's say we got 10. And they run this little route. They go from this site to the disposal and back and forth. And they put in the hours. It's a 24/7 business.
Wow.
So every week I get a report by individual of how many, what their revenue was. So I can line up these 7 people and feed that information back to their manager and saying, this guy is making us a gross of $75 an hour, and this guy is making us $50 an hour. Something's wrong. You need to look into it. And I look for patterns. If it happens once, it's not a big deal. If it happens twice, it's kind of, maybe you need to pay attention to it. And if it happens 3 times, it's a trend. And that's that manager's role, is to make sure that happens. Now, typically, that manager is going to say the guy showed up on time. Yes, he did what he was supposed to do. He might have had problems, whatever it is. But when you present them with factual information and say, look, here's a picture.
Right.
Here's all these guys. All these guys are doing 70 or 75 bucks an hour. This guy's doing 50. Multiply his number of hours times that $20 differential. That's part of our profit.
Right.
Right,
wow.
So, they need to know that, understand it. It's not complicated.
Right.
And they do understand it.
So the decision would be to invest in training. Do I change out the person?
Exactly.
Yeah. How do I fix that problem?
Right. Yeah.
I love it. It's interesting that I like that when I looked at your financial reporting package, you look at things on a quarterly basis.
I do. 1 month is interesting, as we talked earlier. 2 months, if you're seeing a trend, and you get 3 months of something, then good or bad, you've got something that averages out those hills and valleys.
So when you look at your P&L, you're looking one of the versions of your P&Ls,
yes.
And you really slice and dice it a lot of interesting ways. You saw, last year,
Right.
For the year,
Right.
then 2 years ago for the year, then last year by quarter,
Right.
and then the current quarters.
Right.
So what are you doing with that?
Okay, so I take that data and I actually average it out into a monthly. So when you look across left to right, everything is comparable. So when you look at sales, it's average month, and you look at costs, average month, and now you get a picture of how the business is doing. It also enables you to forecast somewhat too, and that goes back to the general manager, and he now has a P&L that shows him. Because I'm never going to, quote, blame, somebody for something that happened in 1 month, because it's possible that you booked something in 1 month, you didn't book it in the other, whatever it is.
Yeah. Weather could change.
Yeah. So but you get 2 or 3 months, and so to me, a quarter is very representative of what the company's doing.
And then taking the quarter and getting it to an average per month for that quarter, that seemed to be the key indicator for you.
Right.
And what I assume these are non-financial managers, right?
Correct.
Right. So they
all the financing is done by GrowthForce.
Yeah.
All the number tracking, all the rest of that.
So we do all that, and you've got an MBA in finance, right?
I do not actually. I haven't. I don't even have my MBA. I went to MBA school because I recognized that with my degree in labor relations, I was woefully deficient on understanding business. So I went to take accounting courses at night, married, 2 kids, and really enjoyed getting educated for the first time. So I continued on and took all my MBA courses, and then I got transferred to Europe.
Got it.
And so before I finished.
The point is, though, you have a financial background.
Yes.
And so what you're doing is you're translating that financial background into a way that a non-financial manager can understand.
Exactly.
And it's taking the quarterly totals, dividing them down to become a monthly average, and then comparing that quarter by quarter for the last year, and then for the monthly average for the 2 years ago. Right. That's really great.
And they can also measure the person, because they say, here's where you came in, here's what you've improved upon, and particularly for the variable expenses. You show, variable expenses. Our 2 biggest expenses are fuel and labor. Those are 2 big ones. Now, fuel almost goes hand in hand with labor, but labor is also heavily dependent on overtime. So if somebody's racking up I break out the overtime hours. I say, look, we're paying, this number of thousands of dollars for regular pay, plus you're paying this number of $1,000 for overtime pay, and you realize if you hire 2 more people, your total costs will go down. You get more work done because you're paying time and a half.
Right.
Now, in the oil business, it's tough because, particularly for the transportation side, these drivers expect to get 55, 60, 65 hours a week.
Right.
So I predicate that,
Right.
but I show the manager, because I've got a little algorithm in the weekly numbers that says, even if we work them, say 60 hours a week, you're still 2 people short.
That's interesting. And then you get them acting like owners because you've created an incentive plan around gross profit. Talk about that a little bit.
Well, this is primarily for the general manager.
The general manager, right?
And I've got the general manager, and I've got 2 subordinates of his, and then you got overhead and other things. So he is based on the basically EBITDA, and then I jump up to the gross profit line, and for the 2 other managers, I take the financial information and say, this part of revenue is yours, and this part of the expenses is yours, and this is where I expect you to be. And I try to explain to him, I said, because the numbers are, for one manager, it's like 63% gross profit, the other maybe 51. But I say, look, don't think that we're making a ton of money because fuel's not in here, all your overhead, your salary's not in here, a bunch of other stuff. But this is, and then I show them, I said, look, if you had run at that number, you would have generated this much more, basically, profit.
Yeah.
And by not running it, we actually lost this much. So they're getting, bonused on that differential basis.
And it's not big dollars, right? It's
No.
$250.
Yeah.
Yeah, but it makes a big difference.
Absolutely, yeah.
Yeah, I love, because it drives the kind of behavior you're looking for.
Yeah, and I want them to pay attention. Yeah, I don't want them to live the detail. I just want them to know that information's out there.
Right. When management monitors gets done, so if
Yeah.
you're monitoring it and they're monitoring it,
Right.
that's what everybody's going to pay attention to. The other thing I liked in your package, I've never seen before, was the way you use the balance sheet. You've got a sources and uses column, which I thought was really innovative, right? So most of the CEOs that we work with, they know their income statement.
Right.
But most people don't know how to read a balance sheet. and your background in turnarounds, that's brings a unique perspective. Tell me about how you use your balance sheet.
Well, it's interesting you say that, because I was one of those people. I'd look at the income statement and disregard the balance sheet. The balance sheet's important. You take the most basic example, which is accounts receivable. Mm-hmm. You can have a great income statement, and you've got one customer that's 20% of your business, and they're not paying their bill. And then at some point you may have to write that off.
Right.
So if you're seeing this big, basically that's a use of cash from receivables going up, money you don't have because they haven't paid their bill, it's a big deal. And the same thing's true of accounts payable. Accounts payable goes up, yeah, that's great, I'm using the cash, but I got to pay the piper at some point. So you do have to track sources, and it's, I say, with Excel, so many things are easy to compress so that you get a picture in very.
Yeah.
And then if you want the detail, just go backwards.
Expand it. And what's nice in QuickBooks,
Yeah.
You can export the reports with the collapse and expand capabilities in there.
Right.
So it's real easy to collapse. And what I like here is what you've done is you got your balance sheet by month.
Right.
And then it looks like you're taking the last 3 months
Right.
and the year to date,
Right.
and you're calculating kind of the change in the asset group or the liability group,
Right.
and then putting in a column that's got sources of cash and a column that has uses of cash,
Right.
so that you can actually see where the cash went.
Right.
So
And that's more for just for me.
Yeah.
Because I'm responsible for that. Nobody else is really,
yeah, but cash is king, right?
Right,
If you
absolutely.
if you don't have the cash flow,
Yeah.
then everybody suffers.
Right.
And I thought it was really interesting, for the audience to see the categories that you broke it into. There were 9 of them. Obviously cash goes up and down as either a source or use of cash.
Right.
Receivables, you mentioned. Operations is kind of the operating balance sheet accounts, like your prepaid expenses and your leasehold improvements. Stuff that you had to use cash for.
Right.
Inventory. Fixed assets like furniture, fixtures, and equipment, and then that's the goodwill, intercompany, and depreciation. Those are all the assets
Right.
that you tracked separately. I've never seen anybody kind of summarize the balance sheet as a cash flow, I mean, obviously the sources and uses of cash is about the comparative balance sheet.
Right.
But this way makes it really easy to quickly see.
Yeah.
And then on the liabilities, you know, it's easier. You have payables and you have the debt, and then finally, you know, equity. So,
Right.
you know, it's a nice snapshot. What do you do with that information?
Well, in our situation, we don't have any debt, I don't use it as much as I do in a turnaround situation, because in a turnaround situation, you may have a batch of assets that are basically not any good for you. I know I've gone through plants and looked at their inventory and looked at the inventory on the shop floor and realized that this stuff hadn't gone anywhere
Right.
in years, you know. And one of the approaches I take when I was doing this as a consultant, I would go to the owner and I would say, would you rather have, you know, $5 million in cash, you know, or would you rather have this business for $5 million and struggle with it? And make him, you know, look at that basic decision, and realize, you know, that, you know, if you had $5 million and you put it in the bank at 2%, you wouldn't have to worry about it again.
Right.
Here you got $5 million, and, you know, now let's say, you know, you decide you're going to go lease another warehouse or do something, buy more inventory. You know, is that really what you want to do? And a lot of them say yes, and some of them, you know, think twice
Well,
about it.
it's a great use of the balance sheet.
Yeah.
So I applaud you for that,
Yeah.
because you know, haven't talked about the balance sheet much on the podcast.
Yeah.
And when I saw your sources and uses on the same spreadsheet as a balance sheet,
Yeah.
I thought that was a very innovative way.
Yeah, because again, you know, when you just look at the income statement, you lose sight of a lot of stuff.
Yeah.
You know, you're repairing trucks and you're capitalizing that and you're doing some other stuff. You don't see that.
Right.
You know.
Especially the receivables.
Right.
So you're a client of GrowthForce,
Yes.
and I'd love to just, you know, share some of the stories about how we help you increase your revenue, improve your cash flow, and lower your risk.
Good. What I like about GrowthForce is I deal with largely the same people. Very responsive. I was talking to Chris Munoz a little earlier ago, and we were joking about, you know, I like that they get back to me because it's easier for them and it's easier for me.
Yeah.
Because I don't want to be calling 3 times to get an answer. And
Right.
typically, what I want to know doesn't take but a few minutes,
Right.
you know, to do it. So I don't like somebody putting that in their to-do list and say, well, I'll call him back, you know,
Thursday.
Right. Yeah, and if you hear from me, if I get back to me, you won't hear from me again for a long time.
Right.
So, you know, you're happy, I'm happy, it all works out.
Yeah.
So I like that part of it. The other part that, and I'm a big proponent of that, I also use staff leasing, is I don't want to have to worry about the fiduciary side of that business. You know, if I hired my own controller, and I've gone in again, going back to the turnaround, I remember talking to an owner of a business that, you know, my bookkeeper was my most trusted person in this organization, and she embezzled $500,000.
Happens all the time.
It happens all the time. It does. And you just, you know, that's a dicey situation. So you don't have to worry about, you know, having somebody that maybe is good, and then, you know, a year and a half later, they quit. You know, then what do you do? And, you know, so I like the continuity, and that's obviously, you know, your concern is keeping that continuity. That's something I don't have to worry about.
Yeah.
So it's perfect.
Yeah. And, you know, we do that by trying to recruit for behavior,
Yes.
not skills. I can
Right.
teach you QuickBooks,
Right.
but I can't teach you to be passionate about small business accounting.
Right. Yeah.
And then investing in their career. So Chris was a bookkeeper,
Right.
got promoted to a staff accountant.
Right.
Now he's your accounting manager.
Yep.
And you know, we got 6% turnover because people don't leave.
Yeah.
And and what do we do for you? What's the most value? So you had some magic words at one point. You said, you know, what I like is I'm driving down the Beltway, and I got a question, and I can, you know, get an answer. Tell me about that.
I can't think of the specific example, but I travel to our location, which is south of San Antonio, on an average every 10 days, maybe once a week, you know. But so I've got, you know, 3 hours of windshield time coming and going. I'll do it in a day. And, you know, I just dial up, I'll talk to Chris, I'll ask him some specifics about something maybe that I'm going to discuss when I get there, and maybe about a payment history, and maybe about, you know, somebody else had called me about something, and it's solved, it's done.
Yeah, and so you're not calling into a contact call center.
No.
Somebody's researching it. It's like having an accounting department down the hall, but you don't have to pay for the hall.
Exactly.
Yeah.
No, and we've been doing this together for 5 years, maybe.
Yeah.
And I think we're both happy with the relationship.
Very much so. And what I like is, we're an a la carte menu of services, right?
Yeah.
So your business has gone up, our fees matched it. When your business went down, we cut them in half.
Right.
So you turn accounting into a variable expense.
I did.
Right? Instead of having to fire a controller, we just say, okay, let's take that out of scope.
Yeah.
What do we deliver to you, and then what do you do with the information?
Well, obviously, the biggest part is you handle all of the invoicing. So we create what we call field tickets on site, and those come to GrowthForce, and eventually those become invoices, and then receivables, and then payments. So from the time it leaves the office in south of San Antonio, GrowthForce is responsible for it. And one of the things that particularly like that we've been doing a little bit more of is chasing down receivables that haven't been paid, number one, and number two, because we give a lot of information in a what we call daily sales worksheet. They will say, hey, you show this as having been done, but I haven't seen the field ticket for it, so I haven't created an invoice.
Oh, that's great.
And that's what's called open invoices.
Yeah.
And the people on site know that that's real important.
Yeah.
And they get ridden real hard if they don't do it.
Do we reach out to them directly, or we let you know?
Both, actually.
Okay, good.
I'll get copied on it and I'll see it. So, for example, I'm going to be going there tomorrow. There's some from 2 major oil companies. It's not, some people's definition huge numbers, but it's over $10,000. We did the work, 8 or 10 weeks ago, and we haven't yet invoiced it.
Mm-hmm.
Now, it's bad enough that because we have to pay everything every day.
Weekly, yeah.
So we got to pay our fuel, our payroll, all the major expenses. By the time we finish doing that work, if our manager or whoever's in charge of it doesn't get the ticket signed for another 4 weeks, and then they take up to 60 days to pay. I think we got most of them down to at less than 45. There's a long, back to your cash flow issue. That's a long span.
So that's how we help you improve cash flow. How do we help
Absolutely.
you increase profits?
The profit side is something that's probably a little more difficult for you guys, because what I do is I rely on your income statements, and when I get them, I will have questions. I will call Chris or Mark or whoever happens to be.
One of your teammates.
Yeah.
You got 3-person team.
Right, and I'll say, why is this here? I'll give you let me finish this thought. So I get 2 financial statements, 2 income statements, and 2 balance sheets, but let's deal with the income statements. So I take that information, I cross-check it, because I do this, to make sure. I take the last 2 months, or the current month and the last month, and make sure the last months are the same, because I don't want anybody to ever change
Prior period.
a prior period adjustment. Once it's closed, it's closed. And those always match out. And then there may be a question about, why did this go into this specific category? Because it's showing up on my variable costs, and it's showing up as an aberration. So I'll go back to the GL, I'll look stuff up, and I'll figure it out.
Do you go into QuickBooks yourself?
I do not. It's all, they send me monthly, they send me balance sheet, income statement, and general ledger.
Mm-hmm.
So from that, I can probably find anything I want.
Right.
But for example, most recently, our manager, who I'm tasked with, really the expenses that are done by credit card, he said, well, it doesn't look right to me. It was a variable expense on supplies. And so we went back and looked at it, and there were some expenses in there. Actually, they were being offset in fuel that was an expense that generated revenue. So we had to clarify that, and that's there'll be maybe 3 or 4 instances of those a year.
Adjustments. A year. Well, that's not bad.
Yeah, it really isn't. And so we communicate on that. But what I'm able to do, and so if for those listening, if you don't know a sum if or a count if or those are kind of or a VLOOKUP. Those are kind of my 3 Excel
Go-tos.
formulas. Yeah.
Sum if, VLOOKUP, and count
And
if.
count if,
Yeah.
yeah. So let's take count if. I get a report from rig data. It's an electronic report. It's in Excel, and it shows all the rigs in East and West Texas. Well, in my summary, I have the counties divided into Eagleford, which is our market, Permian, which is, we have some stuff in the Permian, and everything else. So each week I can just go in, because I've got the county names, I can do count if LaSalle County and give me the number of rigs.
Right.
Yes. So now instead of the manager having to finish, go through that, he can look. He said, look, the rig count has been going up in LaSalle County or whatever county it is. And then we go back and find out.
And
why.
I noticed that on your P&L that you give to the managers,
Yes.
that's the top row.
Yes.
Right? What's the average ring count?
Right.
So that's the driver of your business.
Right.
Number of rigs.
Right.
And then you work backwards from there.
Right.
Well, this has been outstanding. I appreciate you taking the time and sharing all the knowledge that we, that the non-financial managers need. Any other words of wisdom?
I think one of the things that I think works well is a lot of this data you can put into a picture in a chart, which again it's fairly easy to do.
Yeah.
And when you send that chart to somebody, it's kind of visual impact. It's different than looking at numbers.
Yes.
It's like, bam, here's this bar that only goes up here and it should be up here.
Trending.
And here, if I look backwards, they were all up here.
Yeah, so we're big on the KPIs and the trend lines, and show the budget versus actual and the
Right.
direction, both actual month by month and
Right.
trailing 12 months.
Right.
So you can see side by side. I'm glad you mentioned that because, for non-financial managers, that makes it all real.
It does, yeah.
Well, thanks for being a client and a partner, and thanks for sharing all your knowledge today.
Enjoyed it.